Strategic capital raising, Eurobonds versus Greek corporate bonds, opportunities, challenges, and issuer perspectives. Guiding the discussion, Vassilis Gioulbaxiotis, Deputy General Manager, Head of Trading, Sales and Structuring Markets at Eurobank. Joining him are our distinguished speakers, Josef Pospisil, Managing Director and Deputy Head of EMEA, Corporates at Fitch Ratings, Ioannis Maggel, Senior Treasury Director at Metlen Group, Nikolaos Andreadis, Group Treasurer at Titan Group, Dimitrios Skordilis, Head of Group Treasury at HelleniQ. Please welcome them to the stage.
Good morning, ladies and gentlemen. It is a pleasure to welcome you all at today's panel discussion organized by Hellenic Association of Treasurers on a topic that is highly relevant for both issuers and investors. Strategic capital raising, Eurobonds versus Greek corporate bonds, opportunities, challenges, and issuer perspectives. We are meeting at a time whereby the capital markets environment is both complex and full of opportunities. Inflation trends, central bank policies, interest rate expectations, credit spread volatility, global tariffs, and investor appetite are reshaping the funding landscape and shifting strategies within a fluid geopolitical environment. For treasurers and CFOs, choosing the right instrument, the right market, and the right timing has never been more strategic. Efficient access to capital is not just about raising funds. It is about securing competitiveness, flexibility, and resilience in today's challenging macro environment. To help us explore these themes, we are fortunate to be joined by a distinguished panel of experts representing leading Greek corporates that are also seasoned issuers in the wholesale market, as well as a senior executive bringing the perspective of the international rating community. To that end, it is of great pleasure to all of us to welcome Ioannis Maggel, who is a Senior Treasury Director at Metlen Energy and Metals. Ioannis brings almost 30 years of experience in corporate and banking treasuries. At Metlen Group, he oversees the full spectrum of treasury operations, from cash and liquidity to debt capital markets, transactions, as well as structured and project financing, along with the management of key relationships with domestic and international banks and rating agencies. Nikolaos Andreadis, who is the Group Treasurer of Titan, where he also serves as Director and Board Member of Titan Global Finance. Nikos has more than 20 years in corporate finance with a strong track record in strategic funding, risk management, and corporate development. His background spans across both financial services and international business development. Dimitrios Skordilis, who is the Head of Group Treasury at HelleniQ. Dimitrios is a seasoned professional with over 23 years of treasury and project finance experience across Europe. He leads financial risk management and financial institution relationships for the group, drawing on a career that has included senior roles in investment and project finance, particularly in energy, renewables, and infrastructure. Finally, we are equally honored to have with us Josef Pospisil, Managing Director and Head of EMEA Industrials at Fitch Ratings. With more than 26 years as credit analyst, Josef has led coverage across a wide range of industrial sectors, from utilities and transportation to aerospace and defense. His perspective will provide us with valuable insights into how international investors and rating agencies view the creditworthiness and funding strategies of corporates in Greece and across Europe. Together, this panel brings a unique blend of issuer and rating perspectives, which we believe will foster an insightful discussion on the opportunities and challenges in accessing both international and domestic capital markets. Let's start with the big picture. When it comes to raising capital, every discussion and every decision has a story behind it. I would like to begin by asking Dimitrios, what were the key drivers behind your latest or potentially upcoming debt issuance, Dimitrios?
Thank you, Vassilis. Kalimera also from my side to all. The key drivers behind the debt issuance fall typically into three main categories, I would say. It's strategic and competitive, company-specific, Hellenic-specific in this case, and macro market-related. So from a strategic point of view, the capability of a company to issue debt certainly provides a competitive edge, securing access to funding, which can be used for expansion, acquisitions, or other initiatives, while at the same time helping to diversify funding of sources, ensuring resilience and also flexibility. From Hellenic perspective, back in time in 2024, a key driver was, of course, the refinancing of the Eurobond, which was maturing at that time. The need to raise funds for securing day-to-day operation and growth. Also, to try to optimize the overall capital structure, to enhance, of course, the reputation of the group into the financial markets, and last but not least, as we'll say, all this at the same time by assessing any potential tax implications that may arise. Also, I would say last, with respect to macro or market-related, all these macro items always play a decisive role in this kind of exercises. So interest rates or the stance of the monetary policy, and also the timing window for the issuance of the bond, affect significantly the attractiveness and the success of a transaction. So, in short, I would say issuing a debt is not just about an exercise of raising capital, but an exercise to try to find a balance between the corporate needs and the market opportunities, trying to support the long-term strategy a company has and always its competitive position in the market.
Thank you, Dimitrios. Ioannis, why did you choose a Eurobond or a Greek corporate bond versus a traditional bilateral or syndicated credit facility? What strategic needs were you addressing? Was it like refinancing, CapEx needs, M&A transactions?
I think getting in what Dimitrios mentioned, I think we should first know that it is not an either-or choice. It is complementary, and it is part, issuing a bond versus a loan, I mean, is part of an overall long-term corporate strategy toolkit. The larger you become, the more extrovert you become, more you need capital markets. On this front, we need to remember that it is the largest pool of corporate money, capital markets, especially, obviously, international capital markets. In any figures, you might see that year-to-date, only Euro corporates, non-financial, have issued something like a bit less than 300 billion as we speak. So this speaks on its own. With regards to the features of the instrument, irrespective of being international or a Greek bond, under circumstances, market condition, issuer capacity, timing, you may be able to get even better terms. We're talking about long-term profile, long-term maturities, bullet maturities, and potentially, under circumstances, again, I repeat, you may have even lighter set of covenants, reps, undertakings in these instances. So this, in essence, makes it the alternative source of funding, or even the source of funding, to be honest. Last but not least, which is of relevance potentially to some of the accounts of the corporates, we need always to balance also potential constraints, either credit or regulatory, that bank lending community may have towards exposure, single obligor exposure limits. On the second part of the question, as you very correctly mentioned, in the history of the issues that Metlen has done both in Greek bond market as well as in Eurobond market, we have either, as usual procedure language, it has been working capital, refinancing, general corporate purposes, CapEx, everything other than acquisition, so far at least.
Correct.
Thank you.
Thank you, Ioannis. Nikos, how does your Treasury team assess timing and windows of opportunity in the capital markets?
Thank you, Vassilis. Good morning also from my side. Timing is essential for capital markets, as prevailing economic conditions greatly influence the overall demand and the market performance. Let me share a short story. I remember back in July 2014, we decided to issue a Eurobond. And immediately afterwards, the market shut down for all the Greek issuers for nearly 2 years, due to political instability and economic uncertainties in the country. So yes, assessing timing is important. One approach would be to regularly monitor economic global factors, I would say, and market conditions, trying always to identify potential window opportunities.
Thank you, Nikos. Thank you very much. Josef, from a rating agency's perspective, what are the most common strategic drivers you observe among Greek corporates when they decide to issue debt? Are there patterns in terms of financing, capex, or deleveraging?
Good morning from me as well. I mean, it's really a mix. So I think I would echo some of the remarks made here already. So Fitch currently rates in Greece 6 corporates publicly. 2 of them are represented in this panel. And accessing capital markets is usually a function of growth. So you reach certain size, you perhaps reach some limits with your lenders, you look at diversifying your sources. There is, for typically asset-heavy businesses, it is about funding capex, so organic growth. Let's say some other companies may also have M&A opportunities, which eventually they may want to fund or refinance the original bridge financing on the capital markets. So it's really a mix of reasons, but I would say, generally speaking, it's typically related to a growth, which then sort of brings a need to really diversify diversify sources of capital, especially into the international markets.
Which is growth that we're actually seeing currently in the Greek corporate space, because we see more and more corporates tapping either mainly the Eurobond market, but also the domestic one. So this is something that it's becoming a trend, as we see.
Correct. And
this is one of the reasons that you're here as well. Thank you very much, Josef.
Thanks for having me.
This brings us directly to our central theme today, the choice between issuing a Eurobond versus a bond on the stock exchange. Nikos, from your perspective, what are the key advantages of issuing a Eurobond versus an Athens-listed bond, and vice versa?
That's the $1 million question, I would say. So, as Ioannis said before, bond serves as an alternative funding source, where investors purchase your credit and lend you money. So simply as that. Issuing a bond in the domestic market can offer the advantage of competitive prices. As the issuer is well known and well established, investors are more familiar with the credit rating, and they are willing to offer more competitive lower coupons. Additionally, we would say that sometimes domestic issuances and domestic investors, particularly retail investors, may have limited alternatives, so that increase demands and consequently tighten the coupon. On the other hand, international markets are more, we could say, resilient to economic disruptions. They persist to intend the overall environment, and they have a broader depth. If you remember, in 2016 until 2019, before the COVID period, in an environment of negative interest rates and ample liquidity, the Eurobond market was the primary source for all corporates. Now, another consideration is size. A typical size, let's say a Eurobond, the typical size of a Eurobond is not less than 250 million, whereas a domestic issuance can accommodate smaller sizes. There are also some differences in the documentation, but I think they're more subjective, to be honest. I think those are the main pros and cons we need to consider accessing the two markets.
I think you got the $1 million for your questions. Thank you, Nikos. Ioannis, are there material differences in investor engagement, documentation, disclosure, or regulatory hurdles? What role does pricing efficiency, macro factors, and demand depth play in your instrument selection? I know that it's quite a long question.
I will try to be as comprehensive as possible, but focusing on some specific spots. So one after the other, investor engagement. I think that we're talking about institutional investors and physical persons, obviously. The depth, expanding nature profile, extensive coverage of international institutional investors, the different kind of rules, regulations, investment principles, and sub-pockets, let's say, that they do have cannot be compared with Greek investors, institutional investors. It's not a matter of expertise, of being able to evaluate credit. It's a matter that the size of and the split and the differentiation is such that I cannot compare it. With regards to physical persons, the obvious difference is high net worth individuals versus retail, whereas the first one, and considering the minimum denominations that in the two markets we're having, the 100,000 versus the 1,000, is considered that high net worth have ticked the box, have been more expert, let's say. On the institutional investor side, the engagement is completely different in the sense that a roadshow plays a pivotal role. You need, especially if you are not a well-known, well-established frequent issuer in international markets, where you need to present yourself in a very fast, efficient manner, clear-cut messaging, having hopefully a solid financial structure, and also be able to transfer your vision, because you have something between 30 to 45 minutes to persuade an investor to choose you in this day where there might be another 4 or 5 meetings or issues. This is the main difference. With regards to the documentation, disclosure, supervision, all this part, both markets are listed, in essence. However, talking about the Greek bond market, due to the nature of the scope of this to cover as a target market the retail, pure retail, HCMC plays a pivotal role as a supervising body with its meticulous monitoring, auditing, controlling type of supervision, which potentially may be more time-consuming if to be compared with the time that you need to be ready to kick off in a Eurobond transaction. Other than this, I think that some more technical issues are of relevance, documentation, where the use of procedure language, it's more flexible in international capital markets, where refinancing is not an issue at all, as well as the earmarking of proceeds, which, similar to share market, share capital increases in the Athens bond market, for correct reasons, not to be misunderstood, for correct reasons, makes the life less flexible, let's say, for a corporate issuer. With regards to the pricing efficiency, I think it's clear that the size, depth, liquidity, and the smoother market operation of international capital markets plays a pivotal role in the selection, especially of a repetitive issuer, large issuer which cannot be just in the Greek market. And with regards to macro factors and things, geopolitical events, all this stuff, I agree obviously with Nikos. It is more difficult for international capital markets to get closed. However, somebody could argue that in our neighborhood, in our local market, you may be able to issue irrespective of what's happening, let's say, to a certain extent. Yeah. But this is, again, it's on a case-by-case basis.
Thank you, Ioannis. I think that it's quite crucial because Ioannis and Metlen have been seasoned issuers on both the Greek and the Eurobond market. And I'm really happy that the panel is live on YouTube because you've penciled down so many things that there could be a quick guide for those that are looking to issue both domestically and internationally. Thank you, Ioannis. Thank you very much. Dimitrios, do you view the domestic bond market as a stepping stone to international issuance or a long-term alternative?
Well, looking a bit backwards, I would say that the Athens bond market has hosted the last decade a number of corporate bond issuances from Greek firms and multinational corporates targeting domestic retail and institutional investors. Out of about, if I can recall correct the numbers, of total 45 billion euros Greek bonds which have been issued and are currently active, something less than 10%, almost 4 billion euros across 20 bonds are listed in Athens, where someone could find names like, blue chips like Metlen, as you mentioned before. I would say the domestic market is seen from my side more as a stepping stone rather than a substitute of the Eurobonds. This has been mentioned also before from Ioannis. It offers to medium-sized companies certainly a good access to local investors, domestic investors, also helps them to build credibility and to get familiarized with regulatory and disclosure requirements, I would say at a lower price or cost compared to international markets. Having said that, on the flip side, there are some, let's say, certain limitations, which are also clear. Liquidity is rather thin, and the investor base is rather narrow, and also small amounts for issue or size of issues are smaller, which may be good, may be bad. It depends how you see that, okay? So I would say for larger corporates, where actually, or those that they would like to have regional ambitions, etc., Eurobonds is rather essential in terms of scale and diversification. So certainly, the Athens bond market could be seen from a point of view as the training ground for companies to build up track record and to improve their governance, while Eurobonds could be seen as the natural long-term destination for a company to get, let's say, access to deeper pools of capital and, also more, let's say, broader pools of funds.
So thank you for that, Dimitrios. So it seems that although this is not a closed club, it seems to be a club for less participants, the Eurobond one, but not for the few ones. Yeah. Whereas the domestic market seems to be more open for the newcomers. So thank you very much for that. It's quite insightful. Josef, are there rating methodology differences or pricing implications between the two markets for the same issuer? What is your view?
So I've looked at well, first of all, on the methodology side, the relatively simple answer is not really depending on the market. It really depends on the class of debt. But assuming that a company issues senior unsecured debt, either domestically or internationally, is the same class of debt, so the methodology is the same. It would be different if it was secured or if it was subordinated for some reason, then it obviously would have a rating implication. So on the methodology question, there isn't really any difference in terms of which market you access. Pricing is an interesting question. So I've looked at the companies and their bonds that we've rated. Typically, they access the markets in opportunistic periods, which is understandable. And so actually, I think the bonds that we've seen and rated, they were usually quite competitively priced. If I was the commercial part of Fitch, I would say the rating has a benefit in that, and I think we have some evidence for it. Looking at it analytically, we typically assume ahead of the issuance that actually the price will be higher than what the bankers tell us it should be, just because we don't really want to rewrite the rating story if the company then decides to go for it even at a slightly higher price than originally expected. So analytically, we try to be always ready for the worst case, so to say. But I think from the corporate point of view, there shouldn't really be any difference. And again, we've seen Greek corporates being successful in the sense of pricing very well, both domestically and internationally.
Thank you. Thank you very much. Of course, an issuance is only as successful as the investor it attracts. So let us talk about the investor base and the role of liquidity. Ioannis, how would you compare the investor base across the two markets, be it domestic versus international?
I think in order to combine this question with the previous one, which I have forgotten to mention, is that another difference, which is both regulatory but market as well, which is related to the investor and the book building process, is that in the international markets, you may be able to expose yourself in the market just for a few hours, if you are repetitive or a well-known name, which is not the case in the Greek bond market. From regulation perspective, you need to be there for 3 days. So this is something which is a regulatory hurdle, as well as it is related to the strength and the investor base per se. Getting on this specific question with regards to investor base, I think we should make a differentiation, qualitative and quantitative. On the qualitative front, we're talking about type of institutional investors, as we have already touched them, and physical persons. The expanded profile, the very large size, the assets under management, which are counted in trillions in the international capital markets, is the both qualitative and quantitative difference. As far as quantitative type of, let's say, differentiation, I think we need to say that, and also touched earlier by mainly Dimitrios, if I'm not wrong, that, and we have realized in many recent Greek issues that for real demand, the book very hardly can exceed $1 billion or so, of which only a portion is retail, pure retail. Whereas for a good credit, repetitive issuer, good market conditions, this might be some dozens of billions in a specific day, and not just for a single transaction, for a number of transactions within the same day. So this is the other major difference between the two.
Thank you very much, Ioannis. Dimitri, is there a sufficient liquidity in the Greek corporate bond market to support repeat issuance or tap structures? What is your view?
That's the other $1 million question. Huh? Good. I would frame it in, or at least I try to, in 3 quick points. First, liquidity has been improved in the recent years, though it still remains a bit modest, I would say, compared to European core markets. And it's very issue and issuer specific. So the conditions beyond the, let's say, some benchmark-sized deals and well-established credits like in utilities, banking, or energy sector are really becoming challenging for mid-sized companies or the put issuers, what you mentioned before. On the positive side, certainly I would say the investor base has been broadened with banks, insurance, pensions, and in some cases we have seen also selective international demand. As a second point, we have seen that the market certainly can support tap issuances or repeat issuances. I think 9 active as we speak, most of them coming from Eurobank, again, if I can recall correctly. And we have seen in the recent issuances over subscriptions of 7 or up to 9 times, which shows a very strong appetite from investors for good credit quality issuances. So this, on the one side, reflects the strong confidence from investors, and on the other side, I would say, give to issuers some predictability if they want to come back to the market. On the flip side, a bit on the negative, so to say, view on this aspect, as we said before, the depth is rather thin and the secondary market is almost absent. And that creates an issue. So, in short, I would say the market can support repeat issuances, okay, or tap under the right conditions. But issuers need to be always mindful on the size, on the timing, and on the transparency, because liquidity is developing and it's not yet fully mature there. That's my view.
So the general understanding is that it seems that the Greek corporate issues are mainly held for maturity, at least for the retail type of investors, which is fully understandable at the very beginning, I think. Obviously, the improvement of the overall macro environment, as well as, like the Greece becoming stronger and stronger in terms of financial conditions, it allows liquidity getting pumped into the system, and good credits coming with decent coupons are an outright alternative to vanilla deposits or other types of investments, so which plays a vital role. I do understand, though, that when there is traffic, as we say, because there are periods of time that someone can discover that a lot of issuers are coming. I don't say exactly that there is seasonality in terms of issuance, but it appears that before the summer, probably because people are going for vacation,
We need money for that.
Yes, and somewhere around autumn, before Christmas vacation, new issues are coming due. So people have to be mindful on that, as well as banks that are advisors. Thank you very much, Dimitrios. Nico, do you consider post-issuance trading activity and secondary market feedback as important as the primary pricing outcome, which is closer to what we said before?
Yeah, I think, Vassilis, it depends on what we are looking for. If you aim for a Eurobond, secondary market activity, while not as crucial as the coupon, still plays a significant role. Having a liquid product in the market where investors can trade over time supports the demand and the overall pricing. If it's not so liquid, then in the next issuance, probably there will be an issuance premium that should be paid upfront to investors. That's not the case for the domestic issuance, if we can say. The coupon is more important rather than the secondary market activity. And the reason behind that is that the majority of the bondholders are hold-to-maturity investors. So they're more keen for the return rather than for the secondary trading.
Thank you very much. I think what you said is actually quite important. Obviously, the key driver for the retail investor is the coupon per se. It goes without saying that good credits come, and frequent issues are coming at more competitive pricing. And as we say in the banking jargon language, on a disciplined matter, it's always good for an issuer, at least at the very beginning, to leave some money on the table in order for the bond issuance to have a solid performance, and also for the investors to be repeated investors on that front. So thank you, Nikos. How does Fitch actually assess the impact of secondary market liquidity on a corporate issuer's credit profile, particularly in smaller or less mature markets like in Greece? Josef.
Yeah, so now I'm not quite close to bond traders, but my understanding is that it's really only the super large global issuers on international markets which basically manage to populate the whole maturity curve with individual bond issues whose bonds are then relatively liquid on the secondary market, meaning daily trading, right? I think typical corporate that issues every few years, even internationally, the secondary market liquidity drops off quite quickly after the initial issuance. So I think that's still the case. So I'm not seeing that much of a difference than perhaps compared to, let's say, smaller domestic markets, where effectively you issue and then you do not need to necessarily revisit the market until you need to refinance. Of course, the tap question is interesting, but presumably there would be other plans. So, I mean, from a rating methodology point of view, it's really about addressing liquidity, right? In the sense of liquidity of the corporate rather than liquidity of the bond. So the question is, okay, when it comes to refinancing of the bond, is it plausible scenario to assume that they will actually be able to refinance it relatively well? And we obviously look for corporates to refinance quite ahead of the time, or have plans, plan A, plan B, let's say, plan C maybe, just in case, so that it actually doesn't impact the rating. Usually for the higher rated sort of BB category ratings, that shouldn't be a concern when we think about really the riskier end of the spectrum. Let's say even thinking about B-, CCC, then it's a more matter of judgment whether actually the market will be there for the corporate when they need it, and the secondary market may be some sort of guidance into that. But again, from a rating agency point of view, we always ask, okay, so what is your plan? What is your plan B? What is your alternative? And do we consider it credible? Or is liquidity, in terms of your own liquidity as a corporate, actually starting to play a bigger role? Do we need to take it into the assessment more robustly?
Thank you. So it's obvious that building your position on the curve is important, maybe less important in the Greek corporate market, but coming due, and as we have more and more issues, this could be like probably the next discussion of the frequent issues, where the position on the curve, as the case has been on the Eurobond market,
Yeah, I think if the investor sees a corporate as a frequent issuer, again, populating, more than 1 point on the maturity curve, then I think it's more likely that there will be no problems when it comes to refinancing.
Thank you. Thank you, Joseph. Thank you very much. So that actually leads us naturally to the role of credit ratings, which often shape investor perception and pricing. So, Nikos, how critical is a credit rating in achieving competitive pricing or investor confidence? What's your view?
Building investors' confidence and achieving competitive pricing is a gradual process. Being consistently present in the market, establishing a yield curve, demonstrating a solid performance, and successfully implementing a clear strategy are all factors that enhance investors' confidence. It is important to remember that we are primarily referring to fixed income and credit investors who focus on the issuer's long-term repayment ability. So, in this context, a credit rating from an independent agency can serve as an objective assessment that can be a reference point for investors. That said, on the other hand, we have seen issuers with long history, with solid performance, like HelleniQ Energy, that have accessed the market without a credit rating. And I would say this is primarily true in the domestic market, where issuers usually are well established, well known, their credit standing is well accepted, so a credit rating doesn't have a significant influence to investors.
Thank you. It's not the best thing always to hear, but it's reality in some cases that.
Of course, there are issuers that go to the market without a rating. One thing to bear in mind is typically the asset managers have a certain bucket for the unrated issuance, which may fill up quite quickly, and then you basically are targeting a much reduced investor pool. But it's certainly possible.
Thank you, Joseph. Dimitri, how do you actually weigh the benefits and the potential cost of pursuing an international credit rating as part of your capital market journey? Actually, Nikos already paid
that was a good pass, I know, being the only unrated company in the panel. Thanks, Vassilis. Certainly a credit rating, I would say, shapes how a company's funding strategy, because it clearly affects the company, how widely or cheaply or flexibly a company can raise debt over the time. I would say on the positive side, credit rating provides access to international markets, to a large pool of investors like pension funds or insurance companies, which are allowed only to participate or to buy rated bonds, as Joseph mentioned before. On this aspect, actually, it broadens the investor base, reduce the reliance on the domestic market, certainly, and it increases resilience in tougher times. A good rating also could have a benefit on the funding cost side, goes without saying, as the investors are actually demanding lower or smaller spreads. And a potential one-notch up growth can actually be translated in meaningful savings over the bond life. Beyond the market, I think it has been mentioned also before, it is a third-party stamp or validation of the credibility. I think Nikos mentioned that in his statement before, which actually supports credibility against the banks, partners, or suppliers. On the flip side, there are also trade-offs, as always. A rating comes with some annual cost, annual fees to the rating agencies, but that's normal. It also comes with a burden on disclosure and this continuous contact with the investors. And of course, once you are rated, you always have to deal with the risk of a potential downgrade. In which case, actually, you may see in a case of a downgrade of your rating, you may see that your funding costs jumping up overnight. And sometimes this is the tricky point that this may put pressure on management to focus more on ratios rather than on growth. That's, I would say, the tricky point of being rated. So to put it in short, I would say for companies with modest funding needs and a strong local support demand, eventually the costs outweigh the benefits. So eventually or potentially a rating is not a must-have; it's rather optional. But for companies which they want to scale internationally, diversify their funding, and also focus on long-term resilience, having a credit rating normally is a core element of the funding strategy. I would expect to ask you why we are not rated, but I will not answer that question.
Obviously, as Dimitrios said, nothing comes for free in this life. And I have to say that we haven't staged this passing game, transition game. But maybe we're going to see it in the night when Greece is playing with Spain. So I think one is paving the way for the questions of the other. Ioannis, are these rating thresholds that unlock specific pools of capital? What is actually your view?
First of all, we have already shared views with regards to rated versus unrated. So local champions, as already mentioned, well-established names, are able to have access, being unrated as well. There is a proof already in the panel. And there are other proofs globally. Getting more on detail with regards to the level of rating, we know that the investment grade versus high yield levels may make a difference on disclosure, on documentation, on the terms, on the pricing, on the fast pace of opening and closing a book, on the overall way that you may conduct this exercise, and the easiness of getting grasp of a market window, which apparently is always a very important, let's say, point that you cannot differentiate yourself, or you have to be there and to be ready.
Thank you, Ioannis. So, Josef, how does Fitch actually view the evolution of credit risk in the Greek corporate space over the past few years? What are you seeing?
There's a few points. Thanks for the question. So I would like to react to some of the remarks here as well, because I agree that sometimes rating is not always chasing the highest rating. It's about getting the right rating that actually all your stakeholders are comfortable with, right? The management, the shareholders, the bond investors. Because, I mean, if you get a higher rating, sometimes it means you have a bit more restriction on the balance sheet, and that may not be what the shareholders want, or what you like to pursue if you see interesting growth opportunities. But just on the side. So back to your question. So clearly the biggest sort of trend in Greece was the sovereign upgrades in the last 5 years. We've seen Fitch upgraded Greece to investment grade BBB- in 2023. We've had a few upgrades of the corporates that we rate. I think Metlen was one. Metlen was one in 2023 as well, to BB+. And Titan is also rated BB+, but that rating is stable. Both ratings are on stable outlook. So if you ask me where is the rating going, the outlook is stable for both of them, which means that the chances are it will be affirmed next time we go to committee, but it may also change without the prior rating outlook being positive. Again, this is back to where I started. When we assess companies, especially initially, we try to really look through, and the rating is much more forward-looking than backward-looking. And 9 cases out of 10, we see managements and their advisors coming to us with a nice deleveraging story, and okay, give us a rating that actually takes that into account, and we do to the extent that we are comfortable with that story, and can present it to the committee as our own rating case, obviously, which is usually a little bit different. So what I'm trying to say is that usually the initial rating has a little bit of catching up to do. Let's say some of the metrics may need to improve to actually support that rating. Once we get there, and the company continues to improve, yes, we can increase the rating, or if they make a transformational acquisition, or if the business environment improves, so effectively the metrics are the same, but we say, okay, actually the business profile is stronger, then that can support an upgrade as well. In a nutshell, we've seen few upgrades in Greece over the last 3 years. But the story has been relatively steady in terms of the ratings on the corporate side.
Thank you. It's actually quite insightful. So, as we're closing to the end of the session and looking ahead, I'd like to ask each one of you to share your forward view. So, having said that, continuing with you, Josef, actually, how would you briefly describe current global market conditions and actually given record high primary and secondary activity as well as supply, as we discussed, being very well absorbed? Do you consider market window of opportunity closing over the next 12 months?
Thank you. I will have another slot later on, which I'll expand a little bit more, but in a few seconds,
yes.
Again, it's about taking the opportunities. There will be windows when the market is there for pretty much anyone. There will be times where the market is actually closing and you can issue only if you are, let's say, single A and kind of household name globally, right? So I don't think that the next 12 months will be any different from what we've seen before. Clearly, this year, the market uncertainty is quite high. And even the last few days, we've seen sell-off of the treasuries in the US, and gold going up, right? That's a sign of a nervousness. So look, if we look at the whole year, I'm sure that over the next 12 months, there will be times to access market. But the outlook is, let's say, somewhat uncertain.
Okay, thank you so much. So as a closing remarks, and in order to give some key messages also to our esteemed participants, what is actually the closing message that you would like to share with our audience today, Ioannis, from your experience as a seasoned wholesale issuer, as a key takeaway? So I'll start with you.
I would say two messages. The one is I would recommend not to get the markets when you need the money, or when the market believes that you need the money. And the second is that the dilemma will be always there, meaning especially for those that are capable, international versus local bonds. However, even if you act opportunistically once, your overall corporate finance strategy should be long-term.
Thank you, Ioannis. Nikos?
Okay. In my view, bonds are simply another funding instrument for corporates, and at the same time, another asset placement option for investors. Over the years, I have, let's say, established a motto that I would like to share with you as my closing remarks. You don't access the market when you want, but when the market wants you.
That's actually quite insightful, I think, and it could be the motto of quite a few people here. Dimitrios, what's your view?
Yeah, thanks, Vassilis. Let me close, I would say, with also a short takeaway. Eurobonds and the Athens bond market should not be seen as competitive choices. They serve different, but they serve different but complementary roles. So the Eurobonds gives companies access, let's say, to scale and to a broader global reach, while the Athens bond market helps companies to become stronger at home by enabling domestic investors. So the key question to an issuer shouldn't be to choose one over the other, but rather, from my point of view, to align the right instrument to its strategic objectives.
Thank you very much. So assuming that the $2 million or less or more dollars that you paid for the two giants here are actually worth it, and that you enjoyed the crash course of Eurobonds versus Greek corporate bonds, I'm not sure whether the Slido works or not, so I'll probably make a question for people to raise hands. So if you had to issue debt tomorrow, how many of you would you choose the international market first, and how many the domestic one? So international?
Only one.
And a couple of
Sorry.
and the domestic one. Okay, don't be shy. I think like you can raise your hands. Okay.
That was one.
Yeah. Okay. Super.
It's off the record.
So I think that it's about time to wrap up. I've actually tried to pencil down some of the things that colleagues here and friends exchange as views with you. So as we bring this discussion to the close, I'd like to thank our panelists for sharing their insights openly. What we have heard today is that capital raising is no longer just about issuing debt. It's about making a strategic choice, as Ioannis and the rest of the people said here, between markets, instruments, timing, and investor base. Eurobonds offer access to a wider international investor base, liquidity in the secondary market, and usually higher issuance size, while the Athens Stock Exchange corporate bond market provides accessibility to the local retail clientele base, competitive pricing, low denomination, and proximity, as we said. In both venues of issuance, Greek banks have a pivotal role. Each market has its merits, and for treasurers, the challenge lies in aligning the funding strategy with the company's long-term vision, balance sheet, and growth ambitions. We also heard how credit ratings and market perception shape access to capital, how issuers are navigating today's uncertain macro environment with agility and foresight. The common thread running through our discussion is that efficient and well-planned access to capital is a competitive advantage, and the ability to choose wisely between Eurobonds and domestic issuance, or even combined issuances, as we said, will remain a critical success factor for Greek corporates in the years ahead. I would like once again to cordially thank Ioannis, Nikos, Dimitrios, and Josef for their contributions, and of course, all of you for joining us today and vividly participating in the session. Thank you very much, and enjoy the rest of the conference.